as you begin to advance in your financial life, you recognize that debt is not just something that can help you float your lifestyle. It actually can be a tool. So we want to talk about, depending on where you are in your journey, how to understand what a beginner understands about debt, what someone who's at the advanced level understands about debt, and then someone who's at the mastery level understands. And this is what someone at the very beginning level of understanding around debt would believe. They would believe that debt is dangerous. And in fact, that is true, Brian. Some would even say it's chainsaw dangerous.
Yeah, I think that I consider debt in the beginning to be a wealth trap. And let me elaborate what I mean by that is that when we'll cover it in greater detail, we talk about the 3 ingredients to wealth creation. If you're thinking about consumer debt, credit card debt, and other traps that most people fall into, it works against 2 of those key ingredients. If you think about the fact that, because you feel like sometimes when you have this easy access to credit cards, you don't have to be disciplined. There's one ingredient that we're totally working against. The second thing is because you're not disciplined, you might accelerate purchases that you're just not ready and you can't afford. And the problem I have is that it works against that all-powerful time ingredient, because this is, guys, you realize all the time that you're trying to get back out of that hole, paying down or paying off the credit cards, you're missing out on all the wealth multiplier opportunities of that wealth to grow.
So what do you need to do? Well, at the beginning stage, you just need to put up barriers. You need to recognize that there are things you can do in your life that will prevent you from using debt the wrong way. A great one is an emergency fund. If you're following the financial order of operations and you get to step 4, you know that we want you to have 3 to 6 months of living expenses in a fully funded emergency fund so that you don't have to use debt as a crutch. And we also want to make sure that you have appropriate risk management metrics in place, that you are insured against the risks that you can insure against, so that if one of those unknown unknowns comes your way, you do not have to rely on debt to be the thing that gets you out of the tough spot.
Yeah, well done. I think this is the thing. We're giving the American public a lot of credit with this, but I do think it's an important barrier. Emergency reserves, as well as having good insurance protection, is going to keep you from making those desperate decisions where the first place people typically go is the credit card debt. Right. And we know that that is the trap that will keep you from becoming wealthy.
Okay, so the beginner level folks believe that debt is dangerous, but as you progress in your financial journey and you reach the sort of advanced level of understanding, you begin to recognize that debt in and of itself, it may actually be a necessary evil.
Well, yeah, I think about myself. I didn't get a credit card when I was in college because I was scared to death of getting a credit card and what that meant. But I did find out as soon as I graduated college, I quickly realized I needed a car, and I didn't have cash to buy a car, so I had to finance a car. So there is a point where you realize, okay, now we have to graduate from beginner to where debt is a trap, it's dangerous. Now I've got to realize, how do I work with car loans? How do I deal with student loans? How do I deal with a mortgage in the future? Debt is going to be something that's probably going to be in my life.
Yeah, those 3 things that you just mentioned are exactly that. They're, for most folks, the 3 largest, most expensive things you'll ever buy. Your education, if you're having to fund it yourself. Your automobile, it's the thing that gets you to and from your job, as well as your home. It's the thing that literally provides shelter over your head. So if you want to master the advanced level of understanding about debt, you need to know the limits. And knowing the limits is understanding where your boundaries are around these necessary purchases that you have to make.
Well, and that's why I feel like the typical American is like, they're like, well, if you could give me a little, give me a lot. And that's what we know. You need to know the limits. And that's why we've tried to give you guidelines for all these big life decisions. Let's jump right in on the first one is, I told you, car purchase. I had to go buy a car so I could get to my JOB and start this wealth building process. Because in the beginning, I didn't have money, but I had time and I had my skill set. But I needed to get to the job so that I could start creating that margin that created the wealth in the background. And 23.8 is going to keep you safe, because here's what 23.8 does for you. We're going to require that you put down 20% on this new car purchase. We're going to make sure that you don't finance it longer than 3 years. You know what that's going to do? That's going to protect you from buying too much car because you can't truly afford it. And then we want to make sure that your monthly payments do not exceed 8% of your gross income. Now, Bo, there's some overlying things that we put with this too, is that this is never luxury cars. And this is also one of those things where I don't want your car payment exceeding your monthly investments.
If you can do this when it comes to buying a car, you're going to keep yourself inside the realm of where you need to be. Well, Student loans are no different. That's why for most folks graduating, we have what we call the first year financing rule. And basically, this is what it says. You should not incur more student loan debt than you anticipate your first year starting salary to be. Now, there are obviously some caveats if you're someone who's in a vocation that has an extended education period, or maybe you're in a higher earning career like the medical field or something like that. But for the majority of college enrollees, you want to make sure that the amount of debt you incur over your 2 years, 3 years, 4 years of college does not exceed what you anticipate making in your very first year out in the workforce.
Well, that helps us on making sure we have the good debt of education and it doesn't run away from us. Let's talk about mortgages, because this is another big life decision. Now, unlike others, we haven't had to change our rules. We've been very consistent about this. I want you to, if you don't go out to moneyguy.com/resources and look at our home buying checklist, I think you're missing out, because one of the first things it's going to tell you to do is you've got to be in this house for at least 5 to 7 years. And sometimes with these interest rates and some of the other things going on in the market, it might even be beyond that, Bo.
Yeah, absolutely. In addition to having the right time horizon, we say that when it comes to buying your first house, if you can't put down 20%, that's okay. It's not a must on your first time home purchase. But if you decide to put down less than 20%, one of the things you have to make sure of is that the total amount of your monthly payment, the total amount that you're paying on housing, cannot exceed 25% of your gross income. If you find that your housing costs are above that, you're going too far out on the risk spectrum. You likely are buying more house than you can afford. So if you can go out and check out the home buying checklist, you can use the home buying calculator on the website. Make sure you're making this decision well, because once you figure this out in the advanced stage, then you get to move on to mastery. And mastery is kind of exciting because, remember, in the beginning, you recognize that debt was dangerous. And then as you advance, you begin to believe, okay, well, debt's just a necessary evil that has to be there. But at the mastery level, you begin to understand that debt is actually a tool.
Now, don't mishear us. We still say that debt is chainsaw dangerous. I mean, it is one of those things where even myself, every time I sign the dotted line for a new loan, I'm scared about it. I lose a little sleep about it. And I think that's a healthy thing, because it's just like the chainsaw. If you're using this tool and you're not scared to death, you're probably using it wrong. And what do we mean by that is that debt, just like a chainsaw, it's going to make, if you're like, think about, we do commercial real estate on things. Be a lot harder to do commercial real estate if you couldn't use leverage. So it is a tool, but it's also one of those things you have to understand how dangerous it is so that you can know, hey, this is either going to be a tool that is going to accelerate my wealth building, or it's going to lead to my demise. And that we're trying to help you avoid the boom bust cycle that you see so many people get into this trap of debt. So, Bo, we've tried to help them by putting together. You need to understand the difference, and we even have some rules so you can make sure that you're understanding how to use debt appropriately.
Yeah, that's right. If debt is a tool, it's no different than any other tool. Some tools are appropriate for some jobs, and some tools are inappropriate for other jobs. So you have to know the difference and recognize when should debt be utilized and when can it be advantageous, and when should it be avoided and when is it not advantageous. And so we kind of walk through student loans and we walk through car loans, and we kind of told you about mortgages and homes. But when we think about, okay, how do I discern, okay, is this debt good, low interest, productive debt, or is this debt bad, harmful, high interest debt? There's a litmus test you want to work through. And so if you're someone who's in your 20s and you have student loans that are greater than 6%, that may classify as high interest debt. That may not be working for you in the way that you want it working for you. By the time you get to your 30s, it drops down to 5%, and in the 40s, it drops down to 4%. When it comes to auto loans, again, this is assuming that you're following 23.8, but if you're in your 20s and your car loan is below 10%, you may not need to prioritize paying it off quicker than that 36 months. In your 30s, that interest rate drops to 9%, and in your 40s, it drops to 8%. And then when it comes to credit cards, when it comes to carrying a balance, are always a destructive tool. They are not something you should use if you carry a balance. So you should never carry it month to month to month. Credit cards should be paid off in full every month without question.
Well, and think about it. Those 0% credit cards, they're a trap, is because I don't want you to not feel the pressure of that short-term debt, because you know what happens if you don't pay off those credit cards. you're going to be paying 20+% debt, interest on that debt. And that's too far. That's too much. So you need to be scared. You need to kind of respect this tool. So that's why I don't like using those 0% credit cards.